I run a consultancy that consults on a couple hundred million of crypto capital because we consult 1,600 different crypto investors, thereabouts. And when it comes to crypto, everyone wants to know which crypto asset is the right investment. And the underlying question to that is like, why would this crypto asset go up in value, or why might it go down in value? And the question beneath that is like, why do these things have value at all? And people lose track of basic economics when it comes to crypto. And so this video is not going to be this is the token you should buy, this is the token you should sell, this is the point to get into the market. I think there's a lot of that content already on YouTube. This is going to be a reminder of how basic economics ties into the crypto asset sector, which it does. And it's important for you to know why crypto assets have value and why they don't at a fundamental level, because that will inform you in a way that you can use for the rest of your life as to which crypto assets are going to be good investments and which ones won't be. And so I'm going to try and keep this video under 20 minutes, but we are going to start very basic, and we are going to be covering like a few different topics, because we are going to be covering basic economics and then feeding those basic economics into a crypto investment portfolio, or at least a framework for you to build your portfolio into the future. So not much hype in this video, much more focus on the basics. Some background on me, just so you know who I am. I used to be a regulatory attorney at a Band 1 ranked law firm, so a very high profile law firm. I used to advise some of the top crypto exchanges in the world when I was at that law firm. Probably the crypto exchanges you have installed on your phone right now, I probably advised them in some capacity. I left that practice in 2022 to open up a consultancy specifically for independent crypto investors who I thought were extremely underserved. We've got 1,600 customers, there's about, since then, which means that over the last 4 years, me and my team have consulted on hundreds of millions in crypto capital. And I'm also not a bad crypto investor myself. I'm not an active trader, I'm pretty conservative, but because I understand some of the basics that I'm going to cover with you, I was able to turn my personal portfolio from 90,000 to 1.1 million in about 2 years. So we're really going to get to the basics here. We're going to cover what value is, how value accrues, restrictions on value, creating value in crypto, and the test to determine value in crypto, and also the test to determine value generally. The first 3 chunks of this information are basic economics, and it is only in section 4 that I'm going to take those basic economics to the crypto asset class. And crypto is not an exception. Basic economics apply, but no one really focuses on that, even though it's probably the most important information. And so I'm going to try and address that with this video. And then in section 5, to try and make it not so theoretical, I'm going to try and make that grounded for you so that you can inform your investments. And I'm going to apply this test to a few crypto assets to prove my point. So value comes in 2 types. This is Adam Smith, Wealth of Nations 101. This is the textbook for capitalism over the last 400 years. This is just how it works. And so this is not new information coming from me. This is just a reminder. You know, greater minds many, many, many years ago have come up with this information already. Type 1 is commodities. Type 2 is other people's labor. These are the only 2 things that are inherently valuable. Everything else is a representation of these 2, a claim to these 2, and I'll explain why or how in a little bit. So commodities. So these are things that you just consume. So potatoes, you consume it to stay alive. Cotton, you consume it by transforming it into clothing to stay warm and not die. Oil, you burn it for a fire or some machinery, fundamentally to make sure you don't die. This stuff is scarce. You're consuming it. That's what you do with it. You can exchange it if you have a surplus, but the core reason why you can exchange it with someone is because it is consumable to help you survive in some way. That's a commodity. Item 2 is other people's labor. The reason that other people's labor is inherently valuable is because you can use it to go collect more commodities. So if I've only got 8 hours a day, and it takes me 8 hours every day to go and collect enough potatoes for myself, but I want tomatoes as well, or I want wood, now I've got a problem because I've spent all my day collecting potatoes. But if I can control somebody's labor, well then I can force them, order them to go get tomatoes or wood for me. And so by the end of the day, I now have potatoes, tomatoes, and wood, even though I myself only had the capacity to go and get potatoes. So commodities, other people's labor. Those are the only 2 types of valuable thing, and everything we consume in our economy is some combination of category 2 manipulating category 1. For example, if you're watching this on a phone or computer, at its bare bones, all it is, your phone, for example, is going to be some combination of copper, gold, silicone and some other plastics that were manipulated by either Samsung or Apple, the people, the labor of those people at those companies, manipulating those raw commodities to end up with a phone or computer that you're watching this on. A good thing to remind you of here, and this is going to be important as we bring this to crypto later, money is not value, it is just a representation of value. It's simply just a technology that we've created to help exchange the claim to be inherently valuable things, other people's labor and commodities, with each other. It's just a technology. And so I've just built a little simple diagram here. We've got a potato farmer, a tomato grower, and a chair maker. The potato farmer has potatoes, but he wants tomatoes. The tomato grower, well, he has tomatoes, but he wants a chair, doesn't want potatoes. And the chair maker, he has a chair, but he wants potatoes. And so you can see from this diagram that each of these guys wants something, and the person who has what they want, well, he doesn't want what they have. And so it's kind of tough to do business with each other, even though they each have commodities or they each are providing labor. And so every society for thousands of years comes up with money as a technology for us to do business with each other. It's a representation on the two fundamentally valuable things, which are commodities and other people's labor. But it is not inherently valuable in itself. Of course, if you go to an island and I give you $100 US bill, that is of no use to you. But if I give you a potato, or I say to you, I'm willing to go dig potatoes or coconuts for you on this island, that is inherently valuable to you. Now, despite that, we all think that we spend every day trying to make money. And we do spend every day trying to make money. But really what we're doing is trying to create value for the market. Because if we create value for the market gives us value back. And so there's only three ways to create value for the market. Way one is to sell commodities. Way two is to sell your labor. And way three is to sell your capital. So pretty much everybody in the planet, all day, at least 5 days a week, is selling your labor. You're clocking in, you're clocking out, you're working, you're applying your labor to commodities, whether that commodity is something as simple as a pen, if you're a lawyer. So it's a lot of labor, very low commodities. Or if you're a factory worker, where it's like a very high amount of technology, where you're doing maybe the same thing every day in terms of labor, but there's so much technology you're using to produce the output, say a computer or phone. There's always some combination of the two, but everybody's supplying their labor. Lots of people as well sell commodities, and the easy examples to think of are farmers, but even them, they're not just getting potatoes and tomatoes placed on their lap by God. They have to go into their field, they have to labor, they have to use technology to get that stuff out of the ground in order to provide that value to the market. The only exception would be the idea of maybe the proprietor in the late 1800s, early 1900s, who woke up and just discovered that there was oil on his property. He had a huge oil reserve under his farm. And so truly, in that very rare exception, he truly did not really need to expend any labor, and he just sort of woke up and became instantly rich. Aside from those very narrow exceptions where God literally just places commodities in your lap, you're going to be like me and everybody else, where you're spending all day laboring to provide value for the market. The third option is selling your capital. And what all capital is money. And so really all it is the stored right to the two inherently valuable things, commodities and other people's labor. So when you invest in a startup, you're actually giving them the right, your stored right to consume labor and commodities, which is why when you invest in a startup, what do? They go and hire a bunch of labor, and then they go and buy a bunch of stuff for that labor to manipulate. And in these days of AI, it seems that the commodity that everybody is paying for is AI compute. You're paying for electricity. And so when you invest in a startup these days, this is what they do. They take that stored right of consuming labor and commodities, and they go and consume labor and commodities. They go pay for electricity, and they go hire more people. That's the only three ways that you as an individual can create value for the market. Now, one thing to keep in mind here is that technology is the great multiplier for what value you create for the market with your labor. And this is, again, going to tie into why crypto assets have value and why they don't. Value accrues to individuals differently because of technology. Technology is the great multiplier. If all everybody did all day was just go out into farms and dig for potatoes with their hands, no one would be getting rich, no one would be getting poor. It's effectively communism. And you would be all pretty much in the same spot. Everybody would be getting paid the same because there's no technology involved, so you're just getting the same amount of potatoes every day. An example here, an 1800s coal miner, he goes into a coal mine and his only technology is a pickaxe. And so he makes, he grinds 8 hours a day, though probably 16 hours a day, and he makes $1 a day. Probably a lot less than that actually back in the 1800s, but so he makes $1 a day because his technology is a pickaxe. Elon Musk, he also grinds 8 to 16 hours a day, but he makes $1 billion a day because his technology that amplifies his labor is not a pickaxe, it is a rocket ship. And you can do different things with rocket ships than you can with pickaxes. What you will have noticed when you look around your life experience and into society is that typically people don't work independently ever. When you're providing your labor to the market, when you're creating value to the market so that you can get value back in the form of money, you're typically doing it with a group of people. And we've been doing that for many, many centuries. And centuries ago, people had to figure out what to do in the event they're successful at creating value. If you get together with other people, you create value by applying technology to your labor, and then that labor to commodities to produce something like a computer, and you're successful and the market gives you tons of value back, tons of money back, who gets that if you're doing it in a group? And so centuries ago, we started setting up these corporations, these things called companies. They're basically like a collection of rules that we instantiate in the law that says who gets the pile of money that comes back from the market after we successfully create value for the market. And what equity is, or what we now call equity, is basically just the group of people who have agreed amongst themselves to share the rights to the value that is piling up in the bank account that corporation owns. That's what we call equity. Equity is literally a claim to the representation of value, money, piling up in the bank account of the corporation that the group of people set up as a tool to manage the value they're receiving from the market in exchange for the value they first created for the market. Now, I promise you this will all tie in. This is just basic economics still and a bit of corporate history. That is all extremely relevant, I promise. So this was not a rare thing. For hundreds of years, people started working together in groups and they started setting up these corporations, and everybody started having claims, equity, claims to the value received by these companies, these corporations. And people, of course, who love to gamble, realized that they can start trading these claims. And so the Dutch East India Company in 1602, they're the first to issue public shares. This is shares that anyone can invest in. In 1611, Amsterdam opens the first stock exchange, a platform that facilitates the trading of these claims to value. In 1790, in America, the New York Stock Exchange opens. And so for the first time, the claims to the value that is accruing from the output of a group of people working together, basically a share in a company, they start becoming tradable in America for the first time in 1792. Now, this is going to be an important term for when it comes to crypto. We need to define what a security is. So these equity shares, they are securities. And what a security is, it's basically a secured claim on accrued value. That's what a security is. It's why I call it a security. It is a secured claim on accrued value. And as we now know, that basically equity shares in a company are a group of people's secured claims to the value that accrues to that corporation from the value those group of people within the corporation are creating for the market. So that's called a security. And there was never really many laws around these things. So for the 1600s, 1700s, 1800s, there were laws around them, but just not that many. People were trading them without really any restriction for a very long time. But in the 1920s, it was a very healthy economy. It was called the Roaring 20s. It was a very good, healthy economy. But people started getting exuberant in good times, as they do. And so they started borrowing a lot of money, and they started basically speculating on the New York Stock Exchange. They started speculating on these claims, on these securities. And then in 1929, people just went too exuberant. They went too hard and the market crashes. And in the 1930s, the politicians at the time said that the stock market crash was part of the reason that the Great Depression happened, which is pretty intensely debated, actually. And they were saying that if we get elected, we're going to enact so many rules and laws to make sure that the stock market crash can't happen again. And so I believe it was FDR that was elected in 1933. He came out with the Securities Act of 1933 and the Securities Exchange Act of 1934. So this very fundamental legislation that now governs securities, these claims to value. And this is something that hadn't really existed before. And it is something that has had a tremendous impact on the global financial and investment economy and also crypto assets, as we will get into. So this is the rule that you need to really recognize. If something accrues value and it's not a commodity, the law typically wants to treat it as a security, which means that securities laws will apply. Now, let's talk about the 20th century more generally, because this is going to inform you about why crypto assets came to be, and then the intersection between laws and crypto assets and why crypto assets have value. So I know I'm jumping topics a little bit here, but like I said, I wanted this to be a bit more of a foundational, fundamental lesson. So let's review the 20th century. I don't have this in the best order here. Let's start with the second line, which is 1933. So in 1933, like I said, the Securities Act and the Securities Exchange Act comes out, and that's a piece of legislation that for the first time starts restricting and governing how claims to value, secured claims to value, can trade. And this was like well-intentioned. They were trying to prevent stock market crashes, though of course that wasn't really effective. But this body of legislation has had like very big consequence to the economy, like I said a moment ago. For example, it has created a split between the public markets and the private markets. We just had the SpaceX IPO. So a good example of this is only accredited investors, so wealthy people that securities laws say they've got more money, they can take on more risk, only they got access to SpaceX before the IPO, because SpaceX was a private company. It hadn't complied with securities laws yet in order to become public. And so only accredited wealthy investors get access to that. The public investors, so the vast majority of people, they don't get access to it until it's complied with securities laws and has become public. And so that has had a huge impact on the entire economy, to be honest, over the last century. Less and less companies are becoming available to public investors. There are half as many public companies or investment options available for investors now as there was in the year 2000. And of course, because there's so much wealth in the private market, companies are not becoming public very soon. And so what we're seeing is the stock market as it is right now, which is all wealth of the masses are being accrued into a very few select companies that are only going public at very, very high valuations. So these laws basically force the public to buy at the top. For example, I would have liked to invest in SpaceX, maybe back when it was worth $1 billion, but and I could have, I'm an accredited investor. But if I was a public investor, I don't get that choice. I only get to invest in it when it's worth $2 trillion because I'm only allowed to invest in it when it's at its IPO price. So that has a significant impact on many things. So that's started happening since the 1930s. In 1971, the US removed the dollar from the gold standard, and that has been talked about ad nauseum. So many people are talking about how the dollar is being inflated away because it is just not a hard asset anymore. In the 1970s, financial surveillance laws started to increase. 2008, there was another financial crisis because the regulations weren't very effective at preventing they're not effective at stopping people from gambling. It's like an inherent, you can't regulate that away. People just like to gamble. It's an inherent thing to people. And so it's very difficult to regulate away. So, we had the financial crisis in 2008, and then there was the bailout of that. And then, COVID onwards, there's been pretty bad fiscal management. And so the money printing is just not going to stop. There's another $1 trillion of debt being added to the US debt. Every 79 days, there's another $1 trillion added. And the only way for the US to get out of that is to continue printing. And so it's been about almost 100 years of, in some people's opinion, pretty bad government intervention into the investment and financial market. And now I start bringing this back into crypto. So thank you for sticking with me through this. So in 2008, this pseudonymous creator, we don't know who he is, which is really great, called Satoshi Nakamoto, he creates Bitcoin as a technological solution. He thought that there's basically no way to get these politicians to stop intervening in the economy and kind of screwing it up. I need to come up with a technological solution. So he creates Bitcoin. And Bitcoin's main feature is censorship resistance, meaning that it is a tool that cannot be mismanaged or attacked. And the reason it has that very important feature is because it has decentralized infrastructure. There's many different computers around the world that work together to maintain it. And so it's censorship resistant because if you go and try and take it down in America, well, it's going to keep running in China. If you try and take it down in China, it's going to keep running in Venezuela. It's decentralized. It's very resistant. And many crypto protocols and assets connected to those protocols have come up since Bitcoin. And every major crypto protocol and every asset with value, so for example, Ethereum, Solana, Hyperliquid, Aave, Uniswap, they've all been decentralized in infrastructure and they've all been censorship resistant. And that is because every valuable asset in crypto, as you're now recognizing by definition, either needs to be a commodity or needs to have human labor behind it. So if it's not a commodity, there will be, by definition, and that definitional understanding is really important for you to understand, which is why I went through this work. By definition, there must be human labor and technology behind it. And this is true. These crypto assets with value are not just appearing out of nature. They are connected to services that are providing value to the market, and you know that must be true because of the definitions I covered earlier. Value is only either a commodity or other people's labor. For example, Vitalik Buterin, he was the founder of Ethereum. Anatoly Yakovenko, he was the founder of Solana. Hayden Adams, the founder of Uniswap. Steny Kulachov, the founder of Aave. These are all entrepreneurs who have developed services, censorship-resistant services. These names that we recognize, these are all crypto assets we can invest in, but they're also, behind those assets are also services that are providing value to the market. And the value loves these services. They love that they're censorship-resistant. People want censorship-resistant technology, and that value gets passed back to these assets. But this puts a crypto entrepreneur in a true dilemma. Now, the technology and services in crypto that are being built, they're censorship resistant. That is the core feature of like basically decentralized blockchain services. That's the whole point of them. If it's not censorship resistant, you can use Amazon Web Services or Google, whatever, to get the same effect. Now, we're getting to the crypto entrepreneur's dilemma here. So now you know, behind every crypto asset, there are going to be services that are censorship resistant, that are providing value to the market. These services, they need to be censorship resistant to provide value. The connected asset has to accrue value or the network loses the censorship resistant. So the reason that Ethereum has a crypto asset, Solana has a crypto asset, Uniswap has a crypto asset, Aave has a crypto asset, the reason why they are software-based services that also have a crypto asset is because the crypto asset is necessary for the service to work. And so you've got these connected assets that are accruing value. And if they don't accrue value, the network loses its censorship resistance. So the asset accruing value is necessary for the key feature of the crypto service. So the asset needs to accrue value. But the crypto entrepreneur's dilemma here is that the moment their crypto asset starts accruing value, the law wants to call it as security. And so this is the dilemma. The crypto entrepreneur, option A, they allow their crypto asset to accrue value. If they do that, the service, the value they are providing for the market stays intact. If the asset accrues value, it allows the service behind the crypto asset to continue providing value to the market because it is a censorship resistant service. The asset accruing value is necessary for that. But now it looks like a security, and a censorship-resistant service cannot embed laws into the service or it loses the censorship resistance. You basically turn it into a bank and then it fails. And so if you don't embed the laws, you basically let it accrue value and allow the service to stay intact, you risk going to jail because you're not in compliance with securities laws. Option B is you comply with securities laws and you say, okay, even though it doesn't really make sense, I'm going to somehow take these censoring laws and I'm going to embed them into my censorship resistant service. It doesn't even make sense. And if they tried to do that, the service would die instantly. Like if Ethereum tried to embed securities laws into Ethereum, Ethereum just sort of dies. It doesn't even, it's like trying to make water not wet is an analogy I've used before. Like it's just doesn't even make sense. And so then the service dies if you try to do that, it just dies. And so that's a real situation for the crypto entrepreneur. Maintain the service that the market loves, but risk going to jail, or don't go to jail, but then make your service crappy and not useful to the market. And so then crypto entrepreneurs didn't really like this dilemma. They still want to provide their services for the market because the market loves it. That's why these things have such huge valuations, but they don't want to go to jail. So they started getting clever and they started making the crypto assets accrue value in a way that doesn't really look like a share in a company. So you know that a share in a company is like a claim on the money in a bank account, and often shares of companies sort of like pay out dividends. They slowly pay out the money that accrues in that bank account. Well, they thought, well, that really makes it look like a share in a company. And if it looks like a share in a company, then it's really going to look like a security. And we can't embed securities laws, and I don't want to go to jail, but I need it to accrue value. Otherwise, my censorship resistant service isn't going to work. Like the asset needs to accrue value. So I'm going to make it accrue value in a way that doesn't look like a share in a company. So for example, Hyperliquid, right? It generates real revenue, super useful service. The market loves it. And it does what's called a buyback. And so it takes the revenue made from providing the service and it buys the hype crypto asset off of the market, which is basically like a demand. It's like a huge amount of demand on the asset, which pushes the price of the asset up on the market. And so that's kind of like a weird mechanism to drive value to the crypto asset to make its price go up. And it works. Hype is up over 100% in 2026 alone, even though it's a crypto bear market. It just drives that value in a way that doesn't make it look like a share in a company. Because if it looks like a share in a company, it's a secured claim to value, which securities laws that came out in the 1930s say you need to comply with this stuff. Hyperliquid, Aave, Uniswap, they all do their many crypto assets, come up with these weird ways to drive value to the crypto assets because it's necessary for the functioning of the service, which is valuable to the market. But the founders designed it this way because they don't want to go to jail. What you may have noticed is that whether securities laws apply to these crypto assets has really changed since the Trump administration came in. So under the Biden administration, the Securities and Exchange Commission, the SEC, which is the main regulator, the main enforcer of securities laws, its chair was Gary Gensler. And he was explicit. He said, everything but Bitcoin is a security. If Ethereum, Solana, Uniswap, Aave, if they don't start applying securities laws to their services, which, like I said, doesn't really make sense. Like, it will kill the services. It will kill anything. It's not even technologically possible. If these guys don't comply, they're all going to jail. We're just going to literally throw the founders in jail. But then Paul Atkins takeover, which is the Trump administration pick for the SEC. Now he's saying, basically, none of this stuff is a security. Securities laws don't make sense for these services. We actually need new laws. It's not him saying this, actually. He hasn't said this, but he's not saying like all this stuff are securities. He's more accommodating to the argument that like we probably need new laws written for this technology because forcing crypto entrepreneurs that are building useful services for the market, forcing them into this be a good builder and go to jail or be a bad builder and not go to jail, that seems like a stupid dilemma. And what I want to stress to you here is that like the law did not change from the Biden administration to the Trump administration. There's new securities laws did not come out. There was the Genius Act that has come out, but it's not at all relevant to what we're talking about here. What has changed is the interpretation. The interpretation of the laws is political. And so that is what has changed. The laws did not change. The politics changed. If you're anti-crypto, you want a negative interpretation. You would want the Biden SEC chair administration. You would want them to interpret the laws. And if you are pro-crypto, you would want the Paul Atkins interpretation. And it is up to you as the voter to decide what interpretation you want to go with. Now we're getting to a test to understand why crypto assets are going to have value and why they are not, worked up from the basic economics. So the question you will ask when you look at a crypto asset is it a commodity? Basically, do you consume it? Is there a scarce amount and do you consume it? Is that it? And if the answer to that is yes, then the question becomes, how fast is it being consumed relative to the supply? Okay, if it is not something that is consumed, is it a claim on the value created by labor provided to the market by entrepreneurs and the technology they provide? Most crypto assets fall into that category. Then if the answer to that is yes, you then need to ask, are the regulators going to throw that founder in jail? Are they going to let that founder continue building it or no? So we've got plenty of examples of where these founders are not going to jail. So Stani Kulachov is the CEO of Aave. Like, by the laws, he should probably be going to jail, but no one has the political appetite to do that because he's a really good guy building a really useful service that the market loves. Even though if he were to do a securities laws analysis, he would be non-compliant with securities laws. The politicians don't have the appetite to apply the securities laws by the book because they don't feel good throwing good guys into jail. Most of the 30 million crypto assets out there are neither of these things. Like all the meme coins, all this stuff. Meme coins you don't consume. It's not a commodity. This is why most crypto assets are junk. There's only a very, very few out there who are either a commodity with a good consumption to scarcity ratio, and I'll talk about some in a moment. And the other ones that have value, they have value because they are a claim on the value created by the labor of entrepreneurs, developers who are using technology to amplify that and provide value to the market. Let's do this test on Bitcoin, right? So Bitcoin, it's a commodity. So it's very much like gold because what you do with it is you consume Bitcoin. You don't do anything with it, you consume it. And the consumption for Bitcoin, like gold, the way you consume it is not like a potato where you eat it or cotton where you turn it into clothing. You just hold it. That's how you consume a store of value product like gold, silver, or Bitcoin. The consumption is simply holding it and not selling it. There's only 21 million Bitcoin out there. It's extremely censorship resistant and secure. And everybody agrees that the consumption to scarcity ratio is phenomenal because there's only 21 million of them, which is why Bitcoin has gone from $0 to $100,000 each in like 15 years. Ethereum, so under the Trump administration, they say it's a commodity. It's not a security. But under the Biden administration, they were saying it's a security. And here's why. So when you use the Ethereum network, which is a very useful service that the market loves, you need to burn a bit of ETH, the crypto asset, in order to use that service. So it's very much like how you need to burn gasoline to use a car. Ethereum is like that. So it's very much seems to be a commodity in that way. But there is also Vitalik Buterin, who is the founder of Ethereum, and there's the Ethereum Foundation now in 2026, which is a collection of developers that make the Ethereum software more useful to the market, and that drives up the price of ETH. And that seems like a collection of people who are working together to create value, and it seems like ETH would be a claim on the value that those people create for the market, so a secured claim on the value they create. We can pretty fairly put ETH in the commodity camp rather than the security camp, but depends on the political will. The interpretation is definitely up for debate. If you do put it in the commodity camp, which I would, it still has very high issuance related to the consumption, and so it's still not necessarily a good investment. It is long-term, but maybe not short-term. And so you still need to do this analysis of where does it get its value? Is it a commodity that's consumed, or is it a claim on value created? For Ether specifically, it's probably the commodity, but because the issuance to scarcity ratio isn't great, basically it's like having a lot of oil in the economy and making oil prices go down. It's kind of like this for Ethereum right now. There's kind of like an abundance of ETH, even though it is a useful commodity, there's just like very high supply of it. So the price is going down. Hyperliquid, right? So Hype, don't really consume it. You consume it a little bit, but a lot of its value comes from what the Hyperliquid team, the collection of entrepreneurs, their CEO is Jeffrey Yan. A lot of the value that Hype accrues comes from the efforts, the labor they're providing to the market. Is the Hype a secured claim on the value they're creating? Not really. There's no legal contract to that there. But under the Biden administration, they would say for sure that that is a security, and they need to start applying securities laws to Hyperliquid, which would completely kill Hyperliquid on the spot if they somehow tried to do that. Yeah, so that's Hype. So it would be a security under an analysis probably. But you know, the reason why it's up 128% in 2026 is because it accrues value well. And so that makes it a good investment. But then you need to think, are the regulators going to go throw Jeffrey Yan, the CEO, in jail for building a good service for the market? Now take a look at Arb. So Arbitrum is a protocol. It's censorship resistant because it uses Ethereum as the asset of value to maintain the censorship resistance. It's a bit technical, but I'm just trying to keep continuity with the points I was raising earlier, which is in order for a protocol to maintain its censorship resistance, there needs to be an asset of value that is securing it. And so Arbitrum, for the Arbitrum protocol, it actually uses Ethereum. So it takes its censorship resistance from the value that accrues to the Ether crypto asset. Nevertheless, it also has its own asset called Arb. But Arb is down 96% from its all-time highs because the founders and the issuers of Arb didn't want it to look like a security. They didn't want to go to jail. Those developers would have been talking to their lawyers, just like developers used to talk to me when I was their lawyer. And I would say, I love that you want to drive value to this asset, but if you do, it's going to look like a security, and that's going to be non-compliant, and you're probably going to go to jail. And then they would go, okay, well, what does compliance with securities laws look like? And then I would explain to what betting securities laws looks like for the asset and their protocol. And then the developer goes, well, that will completely kill our protocol. And I go, yep, yeah, it will. So it doesn't really make sense. So Arb, you know, those guys would have listened to their lawyers. It has no claim on value. The value that the protocol creates for the market, it does not go back to the crypto asset. So it doesn't look like a security. So the founders aren't going to jail. There's no risk of that. So that's good. But it's a claim on nothing. And so it's down 96% from its all-time highs. And so now this is all tied together, right? So you're not going to come out of this video with any high intensity picks for like, oh, I need to go invest in this asset right now. There's none of that. But you do have a much better understanding about how basic economics that apply to the traditional economy, and will continue to do so as long as we're capitalist, also apply to the crypto asset class, and how you can use that to identify good crypto asset investments. It's this whole regulatory securities laws versus censorship resistant utility question that is like this crazy thing that really impacts how crypto assets accrue value and the risks these projects go under and the utility they provide for the market. It's basically two sides of the same coin. And so to summarize all this, to have value, an asset must be one of two things, and this is in the real economy and the crypto asset economy. It needs to be a commodity with a great consumption to scarcity ratio, like Bitcoin, and like what Ethereum used to be until the issuance started getting too high. It's still a commodity that's consumed, but the scarcity isn't that great. There's a lot of it. And so the consumption to scarcity ratio isn't great, which is why the price is going down. Or it needs to be something that looks like a share in a company, in the sense that all a share of a company is your right, is like your claim to the value received from the market when you first provide value to the market. When you first provide your labor to the market, when you provide value to the market, you get value back, and you've got a claim on the value that you get back. That is what effectively a share in a company is, and that applies equally to crypto assets. And so when you're looking at a crypto asset to include in your portfolio, this is a basic understanding of how economics apply to crypto assets. And when you see crypto assets that are just going up in price, so like Aave, like Hyperliquid, like Tau, like Bitcoin, like Ethereum, it's because they're either a commodity with a good consumption to scarcity ratio, you consume it and there's not much of it, or it is something that accrues value because there are a team of people out there, developers, entrepreneurs, that are providing useful services to the market. And these assets are a claim on the value that is given back from the market. That applies in the traditional economy, that applies in the crypto economy. And all the crypto that is going to zero, which 99% of it will, is not either of those things. And so just don't even waste your time with that. They might get popular in social media. They might be a flash in the pan. They might go up 1,000%, but trying to do that's a tough game. That's a really tough game. And it's much better to keep frameworks like this in mind as you build a portfolio that's going to outperform everything else over the next 10 years, 20 years, because that's what a good, well-built crypto portfolio based on fundamentals will do. It will perform every other asset class over a long enough time horizon, 4 years, 5 years, but you need to make sure you're getting the right assets in your portfolio. And the only way you will do that is by having basic understandings of how economics apply to the crypto asset class, like I've tried to give you here. Thanks for watching.